Let's dive right into an independent, data-driven autopsy of Nvidia's massive first quarter results for fiscal 2027. We're going to cut straight through all the noise in the daily hype to see what the numbers actually reveal. Now, I want to be super clear right off the bat. This explainer is my own independent research and interpretation built directly from primary sources. We're talking SEC filings, earnings call transcripts, and analyst commentary. We are looking strictly at what the data shows and how to read it. This is absolutely not investment advice, and I'm not here to tell you to buy, sell, or hold anything. Here is our roadmap for today. We'll cover 1. The headline numbers, 2. What drove the growth, 3. The market disconnect, 4. The bear case risks, and 5. What to watch next. All right, section 1, the headline numbers. Let's look at the sheer scale of this quarter. $81.6 billion. That is the total revenue Nvidia reported for Q1 alone. To put that into perspective for a second, they are generating more revenue in a single quarter than a lot of legacy tech giants generate in an entire year. It's staggering. And get this, that $81.6 billion represents a massive 85% jump year over year. Usually, when a company hits a multi-trillion-dollar market cap, you expect growth to decelerate. But Nvidia is proving that growth can actually accelerate at scale, depending entirely on the underlying demand dynamics. So the really crucial question here is, where exactly is all that money coming from? Well, out of that total, a record $75.2 billion came directly from their data center segment. That alone is up 92% from a year ago. Gaming and their other segments, they're really just a fraction of the business now. Today, Nvidia is almost exclusively a data center company. And if you look at how this stacked up against Wall Street estimates, Nvidia didn't just scrape by. They comfortably beat expectations across the board. They posted $81.62 billion against an estimated $78.86 billion in revenue. Adjusted earnings per share came in at $1.87, easily clearing the $1.76 estimate. Plus, their gross margins shot up to 75%, which is a huge leap from 60.8% just a year ago. Moving on to section 2. What drove the growth? Numbers in a vacuum don't really tell the whole story, so let's look at the mechanics driving this historic capital inflow. On the earnings call, management pointed out that demand has essentially gone parabolic because, as they put it, agentic AI has arrived. Basically, AI is shifting from just spitting out text to actually performing productive, autonomous work. This shift is forcing hyperscalers to drastically scale up their infrastructure. We're talking about literally doubling the number of 10-megawatt partner data centers in a single year. And this perfectly illustrates their next physical growth engine. The Vera CPU and Rubin GPUs deliver 10 times more performance per watt than the previous Grace Blackwell architecture. But here is why that matters for the financials. It opens up a brand new $200 billion total addressable market for Nvidia in the CPU space. In fact, management stated they have visibility to nearly $20 billion in total CPU revenue just this year. Alongside that operational success, the company really flexed its balance sheet. They launched an $80 billion share repurchase program, and that's on top of the $20 billion they already returned in Q1. Plus, they drastically increased their cash dividend to 25 cents per share. Okay, section 3, the market disconnect. So with record revenues, a massive buyback, and a really solid earnings beat, you'd think the stock skyrocketed, right? Actually, it slid. Looking at the data, Q1 total returns for Nvidia dropped 6.5% compared to the S&P 500's 4.3% drop, and shares dipped another 1.8% the day right after this blockbuster earnings release. This is where the narrative and the numbers really diverge. So what's going on? Well, the data points to a market where absolute, flawless execution is already priced into a very premium valuation. Analysts noted that hedge funds were actively selling Nvidia stock in Q1 to lock in some profits. The options market had priced in a 5% post-earnings move, and when the beat wasn't, astronomical enough to totally break the models, the stock contracted. Wall Street isn't just blindly looking at top-line revenue anymore. They are heavily scrutinizing margins and the incoming wave of competition. Which brings us to section 4, the bear case risks. In any rigorous analysis, we have to look at the vulnerabilities. There's this fascinating friction right now between the core bull and bear arguments. The bull case leans heavily on Nvidia's NVLink fusion strategy. This is the idea that even if hyperscalers use custom chips, they still have to rely on Nvidia's networking fabric, keeping them glued to the ecosystem. But the bear case points out a glaring risk. About 50% of Nvidia's data center revenue comes from just a handful of hyperscalers: Google, Meta, Amazon, Microsoft. And critics argue that these very same companies are pouring billions into developing their own custom AI chips, like Google's TPU and Amazon's Trainium. And look, this isn't just external skepticism. Nvidia explicitly acknowledges this threat themselves. In their Q1 Form 10Q filing, they frankly state that some customers are developing their own application-specific integrated circuits, or ASICs. They note that these frenemies could not only compete directly with them, but could also eat into Nvidia's ability to get enough foundry capacity at places like Taiwan Semi when supply gets tight. And the headwinds called out by skeptics don't stop there. Management confirmed they're assuming exactly $0 in data center compute revenue from China moving forward, all due to strict U.S. export controls. The 10Q warns that these controls risk giving a leg up to foreign competitors who aren't bound by the same rules. Add to this that insiders recently logged 16 transactions of net selling, and the company is sitting on $119 billion in supply commitments. Analysts point out that if hyperscaler demand slows, even just a little bit, those massive commitments could turn into a huge liability. Finally, Section 5. What to watch next. Let's distill the forward outlook and what both the bulls and bears will be tracking over the next 90 days. Nvidia issued revenue guidance of $91 billion for the second quarter, which means continued sequential growth. They also expect those gross margins to remain incredibly tight, holding steady right around 75%. It is a very confident forecast, but one that absolutely relies on the flawless execution of their new Vera Rubin platform rollout. So what's the ultimate question you should take away from all this data? It's not whether AI is growing. It undeniably is. The real question is whether Nvidia's ecosystem lock-in, driven by CUDA software and NVLink networking, can actually withstand the aggressive push for cheaper in-house silicon from its biggest customers. Can they retain those monopoly-like margins as the industry starts to mature? That is exactly what the data says will dictate the next chapter. Just a quick reminder as we wrap up, this explainer is strictly an independent analysis of the financial data and company filings. It is purely for educational purposes and should never be taken as financial or investment advice. Always do your own research, guys. If you found this breakdown valuable for understanding the actual mechanics behind the headlines, keep following this explainer as we continue to translate complex data into clear insights. Thanks so much for watching.